Welcome everyone. Today we're exploring an important business foundation. Separating business and personal finances is about more than bookkeeping. One of the simplest habits a business owner can develop is keeping business and personal finances separate. Yet it remains one of the most common issues accountants encounter. Many owners believe mixing transactions is only a bookkeeping inconvenience. In reality, the consequences often extend much further. It can affect financial reporting, cash flow visibility, tax planning, business decision-making, and even legal protection. The issue is not simply where the transaction was recorded. The issue is what the mixed records prevent you from seeing. Why separation matters. A business owner should be able to answer simple questions with confidence. Is the business actually profitable? How much cash does the business truly generate? What are the real operating expenses? How much can I safely withdraw? How much tax should I expect to pay? When personal and business transactions are mixed together, those answers become less reliable. Financial clarity begins to disappear. Practical example 1. The bank balance illusion. A business owner sees $60,000 in the business account and assumes there is plenty of cash available. After separating personal purchases, tax liabilities, supplier payments, and payroll obligations, only a fraction of that balance is actually available for business decisions. Business lesson: cash available and cash visible are not always the same thing. Practical example 2. Personal spending hidden in business expenses. A company pays for family travel, restaurant meals, and personal shopping using the business credit card. Bookkeeping becomes more expensive because every transaction requires additional review. More importantly, management reports no longer accurately reflect the cost of running the business. Business lesson: poor separation reduces both efficiency and financial accuracy. Practical example 3. Decision-making suffers. An owner reviews monthly expenses and believes operating costs have increased significantly. After investigation, much of the increase relates to personal transactions accidentally recorded in the business. The reports were technically complete. They simply were not meaningful. Business lesson: reliable decisions require reliable information. Financial clarity creates better leadership. Separating finances is not simply an accounting practice. It improves leadership. Business owners gain greater confidence because they understand profitability, cash flow, operating costs, tax obligations, and business performance. That confidence leads to better decisions. Final thoughts. Good bookkeeping is not the ultimate goal. Better business decisions are. Separating personal and business finances is one of the simplest steps owners can take to improve financial clarity, reduce bookkeeping complexity, strengthen tax planning, and build a more scalable business. Sometimes the smallest operational improvements create the greatest long-term benefits. Free small business financial health scorecard. Is your business giving you the financial clarity needed to make confident decisions? Download the Small Business Financial Health Scorecard and identify opportunities to improve bookkeeping, cash flow, profitability, tax planning, and operational visibility. Practical case studies. Practical case study 1. Clean books changed the conversation. Business situation. A growing consulting business maintained accurate bookkeeping but frequently used the business credit card for personal purchases. Challenge. Every month, the bookkeeper spent additional time separating personal expenses from legitimate business costs. Financial reports became less meaningful because management could not immediately determine the true operating expenses of the business. Solution: the owner opened separate business banking and credit card accounts, implemented a formal owner's draw policy, and stopped using business accounts for personal spending. Outcome: bookkeeping became more efficient, financial reports became more reliable, tax planning improved, and monthly management meetings focused on business performance rather than correcting transactions. Key lesson: Clean financial records create better financial decisions, not just better bookkeeping. Practical case study 2. Better financial clarity, improved growth decisions. Business situation. A wholesale business experienced steady revenue growth and believed expansion was the logical next step. Challenge. Management relied primarily on bank balances when making financial decisions. After preparing detailed financial reports, they discovered margins had been declining while tax liabilities and accounts payable had increased significantly. Solution. The business implemented monthly financial reviews focusing on profitability, cash flow, liabilities, and forecasting before approving major investments. Outcome. Expansion plans were postponed until profitability improved. Within 12 months, the company strengthened cash flow, improved margins, and expanded from a much stronger financial position. Key lesson: financial clarity often changes the quality of business decisions more than additional financial information. Common mistakes to avoid. 1. Using business accounts like personal accounts. Mixing transactions makes bookkeeping more expensive and financial reporting less reliable. Avoid this by maintaining separate bank accounts and credit cards for business and personal use. 2. Managing the business by looking only at the bank balance. Cash available today does not necessarily represent available business resources. Avoid this by reviewing financial statements, liabilities, and cash flow together. 3. Waiting until tax time to review financial information. Important trends are often missed when reports are only reviewed annually. Avoid this by conducting monthly financial reviews. 4. Treating bookkeeping as compliance rather than management. Bookkeeping should support better decisions, not simply produce tax returns. Avoid this by using financial information to guide pricing, hiring, forecasting, and growth. 5. Ignoring small financial habits. Small habits such as mixing transactions gradually reduce financial clarity. Avoid this by building disciplined financial processes from the beginning. Action plan. Immediate actions: review whether every business expense is being paid through business accounts. Identify personal transactions currently flowing through business records. Schedule a monthly financial review meeting. Next 30 days, open separate business banking and credit card accounts if needed. Establish a formal owner's draw or compensation process. Begin reviewing profitability, cash flow, and tax obligations monthly. Long-term strategy: build financial systems that support decision-making rather than simply compliance. Strengthen financial visibility as the business grows. Use reliable financial information to support pricing, hiring, investment, and growth decisions. Key takeaways: separating business and personal finances improves much more than bookkeeping. Financial clarity depends on reliable financial information. Better reporting supports better business decisions. Clean records simplify tax planning and improve operational visibility. Small financial habits often produce significant long-term business benefits. Continue learning. If you found this video helpful, continue exploring these related topics. Financial information is a tool, not just a record. Learn how financial reports become management tools instead of simply compliance documents. Why having more reports doesn't always create better business decisions. Discover why clarity, not reporting volume, drives stronger business performance. Why hard work alone won't scale a business. Understand how systems, operational visibility, and financial clarity create sustainable business growth.